Hey Boston, let's talk about credit. My name is Julie Demuz. I am one of the financial coaches at JBS Boston, a network partner of Boston Builds Credit, which is Boston's first citywide credit building initiative focused on helping Boston residents achieve a prime credit score, build wealth, and remove barriers to success. Boston Builds Credit was developed by United Way of Massachusetts Bay and Merrimack Valley, LISC Boston, and the Center for Working Families to help Boston residents achieve their financial goals and create actable solutions to economic disparities in the city of Boston. Welcome to our 4-part series on foundational credit building concepts. Thank you for tuning in, and be sure to hit the like and the subscribe button and follow us on our social channels. Credit. Where do we start? It seems like every day we hear new things about credit reports, credit score, credit repair, and other topics surrounding credit. So, what is credit exactly, and why does it matter? In this series, we will explain some basic credit concepts and give you the facts about credit. By the time you finish this series, you will have the knowledge and the tools to start or advance your credit building journey. Credit can be loosely defined as the ability to borrow money or access goods and services with the understanding that you will pay later. Credit can be in the form of a loan, a credit card, or a line of credit. There are many types of loans and credit cards, each serving different purposes. Think of credit as the result of agreement between an individual or entity who needs to borrow money and a lender, also known as a creditor. Just a heads up, a debit card is not considered a credit because you are not borrowing money. With a debit card, you have access to your own money in your bank account. Where might you access credit? Lenders can be a mortgage or auto loan provider, a credit card company, or a bank. Merchants and service providers might own or have partnerships with lending institutions to issue credit to their customers. When lenders provide individuals and businesses with access to money, they do so with the expectation that the funds will be paid back in a certain amount of time, and with an added cost that makes lending worthwhile for them. This borrowing cost is called interest, and it is charged as a percent of the amount borrowed, called an interest rate. So now that we know what credit is, we can discuss the concept of credit scoring. A credit score is a calculation of the overall borrowing and repayment activity of a customer over time. This calculation places a numerical value on that activity to indicate how responsible the customer is at paying back existing and past creditors. Simply put, the credit score is used to measure the risk of lending to a potential customer. Lenders use credit reporting companies or have their own credit system that generates those scores to measure how likely it is that a borrower will make payments on the money they want to borrow. Most creditors will use a third-party professional service to look at people's credit scores. Two of the most widely used services, FICO and VantageScore, assign a creditworthiness score that typically ranges from 300 to 850. FICO is the most widely used scoring system by the majority of lending institutions. Before credit scoring systems, creditors might have gauged your creditworthiness by reputation alone. Obviously, this method was subjective and prone to error, manipulation, bias, and discrimination. These days, credit scoring provides a more objective approach. Lenders often look to your credit history, your record of borrowing and repaying funds as the first step in determining whether to issue you a new loan, credit card, or line of credit. Many factors contribute to how credit scores are calculated. These include payment activity, length of time using credit, amount of total credit card balances you owe, and the types of debt you have. The credit score helps the lender to determine how much risk a particular borrower places on them if they decide to lend to that person. The higher your credit score, the more likely the lender will issue you new loan or credit. A higher score also benefits the customer through the lower interest rates and better loan terms, since a higher credit score means that you have demonstrated responsibility in paying back previous debts reported to the credit bureaus. If you have a low credit score, you are likely to pay more through higher interest and fees, increasing the cost of borrowing money. While credit scoring systems establish a standard guideline, lenders may vary on their decision to lend and how much to charge the interest. It helps to shop around and compare. People with the highest credit score, often called prime scores, get the best rates and terms on loans and other products. Those with lower credit scores, sometimes called subprime scores, may have to pay more for loans and services, may need a co-applicant, or may be denied altogether. Regardless of where you are starting from, it is important to focus on improving your score by demonstrating repayment responsibility and discipline. Which score? As mentioned, lenders use different scores to measure risk for each of their unique lending purposes. Basically, lenders might be looking for distinct characteristics in borrowers applying for different types of loans. Credit score developers have designed a variety of calculations and formulas to meet lenders' needs. And as we learned in Credit Jeopardy, there are dozens of different scoring formulas available. This means that you have many credit scores. Establishing credit for the first time or rebuilding credit can be difficult. But there are strategies that can help you to safely establish or rebuild your credit standing. Later in this course, we will discuss strategies for reestablishing or rebuilding credit. If you don't have a credit score, the good news is that there's nowhere to go but up. People with no credit history can often establish a good credit score in as little as 6 months, with on-time payments on one loan or a credit card. The bad news is that if you apply for a loan or credit card, you might be treated as high risk, which may translate it into a denial of the credit application or more expensive loan terms. This is why credit building is so important. To summarize, credit can be loosely defined as the ability to borrow money or access goods or services with the understanding that you will pay later. Credit scores are numerical value on an individual's borrowing activity and the history paying back creditors. Many factors within credit scoring formulas influence the final credit score. Factors include payment activity, length of the time using credit, amount of revolving debt you have, and the types of debt you have. While there are many different credit scoring formulas, the most common scoring range is between 300 and 850. If you don't have a credit score, the good news is that there's nowhere to go but up. People with no credit history can establish a good credit score in as little as 6 months, with on-time payment on one loan or a credit card. So now you know some credit basics. Thank you for tuning in. Please remember to like, share, and subscribe. And be sure to check out future videos in this series from Boston Builds Credit.
Thanks for tuning in. If you'd like to learn more about Boston Builds Credit, sign up for financial coaching, or connect with us, visit www.bostonbuildscredit.org or follow us on social at Boston Builds Credit. Thank you.